Awesome.
Late again.
Better late than never, though. And another Prospero
Yeah.
weekly update. Back at it. There's a lot to talk about it. This is a big week with the FOMC meeting and a lot of events happening. But I believe we want to start off with the stock we talked about last week that's been ripping, which is Tesla.
Yes. This is one that was very interesting that we obviously flagged down a pattern where last time we saw this pattern, Tesla went up 70% in a 5-week period when we basically saw it fixated at the top of our 0 to 100 scale in an option sentiment. We called that out in our last letter and basically it was up almost 50%, 15% last week. And the thing about that is I went back for the newsletter this week to kind of review it, and the graphs are almost identical, as I'm probably sure will be shared right here. It's pretty exciting that we can see this is now the second time, Alibaba the first and Tesla being the second, that in a short period, we basically saw repeats in net option sentiment that were immediately followed by big, bull rips in the stock. And, if we can keep, especially on an individual basis, and I always emphasize this in looking at the stocks, that it's really a big deal to see these patterns repeat. And every stock has its own kind of relationship with the signals. And I certainly, a lot of my success around, I just updated the newsletter picks, still at about 73% on the year, pretty fixed on that. The last few updates, I've been 73 to 75%. But the annualized beat versus the S&P 500 is up to 137%. So obviously those picks are doing very well. And I'm leveraging these strategies of getting to know kind of the individual relationships of the stocks and these signals. And basically knowing when to strike when I see certain things lining up. Which segues to a few stocks that I think are pretty important to look at this week. I've mentioned Confluent, CFLT, in 2 newsletters now. It was in there and up 5%, and it has an investor day today. So if you're watching live, you're probably the only people that are going to get this information in time for the 1 p.m. Eastern investor day. I expect them to really raise their forecasts. And the way the market is responding with very high net option sentiment, we've seen upside breakout kind of ramping up in response to it. The social sentiment isn't there, which is interesting because I don't necessarily think that that's a bad thing when it's something around kind of an investor day or something like this, where institutions are much more likely to have inside information and knowledge of what's going to happen at this meeting than everyday investors. But I do expect the social sentiment to kind of rocket up as the week goes on. And I do expect this investor day to go well. Obviously, there's some macro forces that we'll talk about later. But yeah, I think in terms of just the stock and this investor meeting, I think it's a very promising setup, as well as something like look at the market around. Like Confluent does real time, they specialize in real time cloud data processing. And you're talking about all of these generative AI applications. That's exactly what they need. Real-time time series. They have a database called Kafka, which I know a lot of people that use. I don't use it specifically, but I know it's very popular and it's very popular and I would say kind of when you're dealing in the petabyte data ranges and doing a lot of repetitive tasks, which especially these kinds of interactions with generative AI. They can be very repetitive and a lot of the same questions and a lot of the same kind of database queries. So yeah, that's a name that we love right now that I think should have a good week. Obviously we have those macro forces, but if those macro meetings go in the right direction, it could be an absolutely huge week for Confluent. So a good time to get in. Oracle is a name I never thought I'd be talking about in terms of great Prospero signals. I kind of considered it to be a dinosaur. I certainly didn't see it. I saw it pop up as a 92 social sentiment. And yeah, it got an analyst upgrade this morning, going into its earnings this afternoon. And I just think, yeah, everybody kind of expects the same generative AI stuff that has touched a lot of other people in their business to touch them as well. And I mean, here's the thing. We're basically talking about, they manage compute. They're kind of an old way to do that, an old database system. And like a lot of different, types of computing support. I would say they tailor more towards kind of older organizations, whereas new organizations like to implement things like in pure cloud, Google Cloud, AWS, those kinds of things. I would say the people that are with Oracle were kind of people that were building out big data applications before that was a popular word. But it is very interesting because everybody is kind of forecasting more compute. Everybody is kind of moving towards integrating more advanced technologies, integrating them. And even if you're kind of using old structures for servers and older databases and things like that, everything gets touched by this. If you're going to need to access the data more, you're going to be using more compute, even if it's housed somewhere else. And I think that's why there's like a buzz around Oracle. So again, that's probably one that if you watch these live streams, you're gonna have insight into that kind of before these hit the short form videos.
So you mentioned before with some of the things you're seeing with Tesla, how your proprietary algorithms are like catching up these signals, and the more you are predicting and then you see that you are correct, you get more confident in these signals, and it's just like it can only get better from here.
Yeah, absolutely. And I would say like beyond that, there's the practical side of just I would say I trade confidently, but I've traded for long enough that I don't trade overconfidently. I'm never going naked options. I'm always hedging to the downside. Like, I was talking to some like Facebook learning group the other day, and I say that it's just like, even if I'm taking an option, let's say a call on a single stock, I'm almost undoubtedly long SQQQ, which is a 3x levered QQQ downside ETF, or I'll have put options on a stock I don't like, so I'm basically playing both ends. But so I always trade like that. But regardless of that, I would say the thing that these signals and Prospero has helped me do that I could never do that confidently, and I would say that like pro traders are able to do this probably without signals like we have now. But for me, the thing that it helps me most with is like I bought ENVX, one of the short term, like we called them small cap ones that we recommended, which has done well since we recommended it. But it was down 8%, and I bought it down 8% on Monday. And that was near the week low, about like near about 1290. And it went up since then. And I never had the confidence to do that. Prospero signals basically staying high, things like net option sentiment and upside breakout, and kind of the long signals that I depend on. Upside breakout being the long-term options markets favoring it, and net option sentiment being the short term. So if I see those both agree, it's kind of a really interesting check that I've created by design, where it's separating those two markets. A lot of the times they can disagree. And if I make sure they agree, that does give me an added level of confidence. If they're both either ascending or staying, at flat or close to flat high levels in our bell curve, that really gives me a degree of confidence that I've never had before. And Tesla is a really good example. Last week, I cleared a nice week on some Tesla options. I spent about 3,000 and made about 4,500 on top of that, buying them on Monday. But what I did is there was a dip. I believe it was on Wednesday. There was a dip, and I bought some more. So yeah, I'd say that that's something that especially in the short term, that's something that net option sentiment just creates for me that I never had, where I wouldn't be able to say, like, if the stock was going down, I wouldn't have the confidence to say like, oh, my short-term thesis is right. I was always confident in my long-term thesis, and I wouldn't mind holding shares of Tesla, through whatever ups and downs. But in terms of short-term, in terms of negative price action, that's something that Prospero net option sentiment has really enabled me to be able to do, where I'm just saying, hey, net option sentiment hasn't moved. It's still really high. Tesla, it was fixed near 100 the whole week. It didn't move from that. I said, hey, I like this signal. I'm buying if it goes down.
And for people watching and investing, when you're talking about the time frames of short and long term, what are those? Like, I feel like short could be a week or it could be a year, depending on what type of investor you are. So
if you're a short-term investor, I would recommend checking whatever signals you use, 4 times a day minimum. So let's start there. So net option sentiment, we recently did a back test. And basically, we're looking at moving averages of net option sentiment. And basically, for a stock, if it's 25% or above the 7-day moving average for net option sentiment, the test group we did for almost the last year was over a 500% annualized return for 1 day forward from that signal. Now you go 30 days forward from that signal, and it's a 28% annualized return. I tell that story because that tells the story of the decay from the signal relevance, right? It takes this moving average, and it's still a good signal for about 30 days after in terms of making what is considered a very nice return, but it's not the same return as you get when you act on it quickly and you just hold it for a day and get out. And the rest of that is like, you got to watch it, right? If it's staying solid at the top, and what I love about Tesla is it's staying very solidly at the top of our scale. And that gives me a very, very high degree of comfort. But in terms of, things that move, one of the big stories that I tell with net option sentiment is like, some people are just like, well, should I buy stocks with an 80 net option sentiment? And I'm just like, well, that really depends. Was it at 90 yesterday? Because then I wouldn't buy it, even though it is still at 80. So like the directionality of these things really matter. And yeah, you could, a short-term signal could very easily just stay where it is and be good for, what we saw with Tesla was months. It was good, but that's because it was staying right where it was near the top of our scale. Some net option sentiment is super volatile, and I wouldn't necessarily even recommend trading on those as a signal. And, we show our time series graphs for that reason. If you see a lot of volatility in that, and actually net option sentiment updates every 3 minutes, but those graphs are actually open midday close. And we're actually not trying to withhold the signals. We're actually trying to give that clarity where we're spacing out in between. And so you can actually see the patterns, because sometimes you could actually have a few readings in a row that are right the same. But if you don't zoom out and see that it's kind of like pretty wavy, I see ones that typically go from the top of our bell curve 80 to the bottom 20, all in the same day, and can just cycle like that for the week. And essentially, just so people know what they're seeing, those are people cycling in and out of options, especially more thinly traded options. It's really hard to make a large cap stock do that.
Or robots.
Oh yeah, probably robots more than people.
Yeah.
The hedge fund, but probably both, but more so robots. One of the things that I always say about retail investors that just expect to win without putting in some like deep research or really working to find their angle is, I'm just like, you are competing against robots and giant robots. So the fact that you expect to win means you don't really understand what you're up against. Like I feel very, I've got a good streak going here, but I feel lucky, like I came out of that I stuck around a great battle. Every week I escape unscathed. And that's really what most professionals feel like. It's not like, and I'm not saying that, I don't have a lot of confidence in my abilities and the signals that I built, but most professionals know who they're up against and know how smart all the people and all the systems and everything that they're up against are. And that's something that not enough retail investors really take to heart. And why a lot of them, I think, face big losses. Because they get more and more confident because they've had some wins, but statistically, everybody's going to get some wins. And the big mistake is thinking that you're better than you are. Whereas I'm always looking behind my back. And, even on things, Confluent is an example of something that I liked for this week, but I was even thinking, should I just stick with Tesla and Meta? They're safer, larger caps. This FOMC thing could really cut in. I'm confident in this investor day, but smaller cap stocks, it has a 40 profitability compared to on our scale compared to Meta 82. And Tesla, I think, is at 63. So markedly different. And that profitability really helps to defend your downside versus one that's a below average in that. So yeah, I was even I thought about that for a lot of the day yesterday, whether I was going to cut it. And so yeah, I think that's a really, really important thing for people to remember, and a good question.
And for the rest of this week, it's going to be so interesting to see how the signals turn out with the FOMC meeting and CPI and all that coming this week. So what do you expect out of all of that?
Oh, it is a very, very interesting week coming up. Not only like CPI and FOMC being in the same week. There's key jobs reports. It's just like probably, what I've seen called on FinTwit the most important week of the summer. And part of that is like, I don't know if a lot of people know this, but like a lot of people on Wall Street just like take the month of August off. That's like their time to finally get away. So it's very thinly traded. And yeah, like I would there's always some peculiar things. So this being the most important week of the summer, a lot of like is not the biggest thing. But it is very interesting because we are seeing all of this momentum and expectation behind this pause, where people are now betting kind of 70-30 that there'll be a zero change on rates. And then the next two meetings both have closer to a 60-40. Like, I don't think they might adjust if one or the other happens, but basically like they're betting more on a raise next meeting than not. And that's very interesting behavior. My guess about what's going on there is everything I've read is that they're now like very two distinct factions in the various feds around the US, and obviously they combine to become the larger Fed. And the schools of thought are one, let's not kill this potential soft landing opportunity that we have, where we are seeing non-severe economic impacts and the market kind of coming back while inflation increases are subsiding. I think it's important to look at as part of this consensus. The last three meetings, consensus raise 2 months ago was 5.2%. That's year over year, and it ended up being 5. Then I believe it was 5 was the forecast, and then it was 4.9. So not only do we have two beats, we also have numbers that are like pretty close to each other in terms of how much the inflation is kind of dissipating. But the forecast is 4.1 for May, and obviously May numbers are released in June. And that is very interesting because that's a big drop. And not only is that a big drop, if we continue this trend of beating the consensus, that is definitely something that I think the market's going to react very positively to. It is one of those things that how intertwined it is between kind of between what we I was just thinking, like, is this definitely broadcasting live?
Yeah, I'm watching it.
Oh, you are. Good.
Yeah.
All right. Because I was just like, I paused it on my thing because it was making noise, and I was just like, oh crap. Like,
Yeah,
this is
we're
what
good.
goes on in my mind. All right, sorry, watchers. We've got 6 this week. We're really
Leveling up.
we're really moving up in the world.
If you're interested in watching, ask a question if you're curious. We'll try to answer it.
Yeah. But I'm glad we're still broadcasting.
Mhm.
And yeah, so like some of this stuff is intertwined, where if we have a really reduced inflation reading, obviously that may affect what the Fed says. They might be more hawkish. They might feel they have more room to be hawkish about future rate increases, because they basically might say, hey, it does look like we have inflation under control, or at least moving towards our target rate. But say like jobs aren't where we are. So, the fact that we aren't kind of killing market growth might give us more room to consider that in the next meeting. So, you can never rule anything out, how these things are intertwined and how things might change. But I really think flat or consent, like, if it's at consensus at 4.1 or anything beating that, I think we're going to see a really nice market like for the next month or so. And I do believe that's what we're setting up for, that expectation that would happen. And the market, I think, what ends up happening in these things is as these meetings get closer and the market gets more sure that we are going to have this bigger inflation reduction, that we are going to have this rate pause, it's kind of a running start into that. And that's what we're seeing. On the risk side, I think we could probably even stomach above consensus. 4.2, 4.3, I still feel pretty comfortable saying that it's not going to be a huge hit to the market. And that's just because look at it this way, markets don't like, and I think it might still be a hit that day, obviously, but I'm talking about like in terms of like until we get the next reading, for example, in this next month that I'm feeling bullish about, obviously, especially if these things stack up, being the consensus or lower CPI leading into the rate pause, obviously being, I think a very, strong month to be expected for the market. I even think at 4.2, 4.3, we might have a dip, and then, still a pretty good month ahead. After that, who knows? We could have we've got a lot of exuberance in the market. And one of the things I'm talking about in my newsletter is beyond that, what could happen is just like a chain reaction. There's still tons of institutional shorts in the market. Like basically, I think I shared a stat that said last week, 23% of funds were beating the S&P this year, which is nuts because typically that averages about to, I think 40-ish%. And I think that's about where it was last year. So yeah, like a lot of funds were shorting this market and are getting torched. So the other side of that is those guys, like they haven't really capitulated yet. No real evidence. I think some of that started happening next week, but they're going to look for blood in the water. So if they see something like that's where it as it starts to drift above that, and maybe you get some hawkish remarks in addition to inflation above consensus, you might see some blood in the water and extra shorting, basically all these institutions being like, oh, I want to prove myself right. And that's, I think, still, one of the primary risks in the market. And I think that was our next topic. So I can probably just, unless you want to ask me the question so you can have it on.
I actually have a few questions before we move on, but so if my memory serves me correctly, last March was when inflation started really moving higher. So coming over, as we're overlapping those months now, the base effect should become much higher. So I would be surprised if inflation remained high because it's over last year's high numbers, right?
I think that's what we're starting to get in terms of just the inflation was pretty serious. So the fact that it kept up, even though the numbers were high, is not surprising. We've talked about this before, but of this inflation, 51% was corporate profits. And that's normally around 10%. So obviously this dip in the market has helped that, but you got to keep in mind, it wasn't that much of a dip and people started beating their estimates again, the beginning of this year. And that's what a lot of this exuberance is about, where it's just people especially tech, they have exciting business prospects. They cut a lot of their workforce. And so, yeah, people think those profits are coming back. And there's a lot of companies that are just huge that are growing these new big businesses. One of the things that I actually think is insane that I was on a value investing Twitter yesterday, and I was looking at kind of a simple value thesis, and one of these weird exuberance things that I noticed is in terms of 2024 earnings, Apple is about 30 times, Microsoft is about 30 times, and Google is about 20 times. And when I talk about exuberance, that seems to be one of the weirdest things to me. And we've talked about this before, and it's just yeah, I think ChatGPT is great. So many people are using it. It's going to be a huge monetization base for Microsoft. But there's just not a ton of evidence that yeah, maybe it eats into Google search, but Google has the best, we've talked about this, the best AI technology of any company. They got the best brain. They still have an amazing training set. Like, and even if they do lose some search, there's all these other AI businesses that are going to sprout up, and they have a huge cloud platform, I think better than Microsoft's. So like, yeah, like I don't like, even if you do buy the thesis, which I don't necessarily, that Microsoft is going to like be better than Google and AI long term. I don't necessarily buy that thesis. But even if you do, like, it isn't necessarily a reason to have Google trading at a discount to these other large companies, because their business is going to grow too. They're a big AI player. So there's plenty of additional market and business to go around. And that's just like a weird mispricing that I saw. But yeah, there's a lot of this exuberance in the market. And I think that like that gives every reason for these corporate profits to be high, because a lot of them are kind of intertwined with the share prices being good, and I would say things like stock bonuses to employees that are worth a lot and they can sell. That's just putting more cash into the economy. And yeah, I know we're going to talk more about this later, but like, yeah, one of the things in terms of people's concern about inflation is not, and something that Powell talks about a lot, is not even necessarily the core CPI, everyday goods, just like upwards pressure in price, or things like supply chain that was putting a lot of pressure on that. It's actually, a lot of cash from, jobs, which remain strong, staying in the market. And even if there's not the same kind of upwards pricing pressure and supply chain issues, that there's just going to continue to be a robust job market, growing wages, especially in tech, that are going to, maybe move back up as all of these, and certainly profits, as those businesses grow. So yeah, I think that that's something that, is a big worry in terms of ongoing inflation, because obviously if jobs stay good, tech remains strong, profits are growing, these stock bonuses are healthy. That is going to be a big driver of, ongoing, obviously a non-need to lower prices to get people to purchase goods. And there might even continue to be flexibility to raise prices. So that is definitely a concern.
Mm-hmm. Yeah, so you just touched on a few worries, and over the past 2 years, it was so locked in on, first it was the pandemic, then it was inflation, the debt ceiling kind of for a week was a big story, but there was always one big boogeyman for the market where everybody could point their finger at and be like, if this happens, it's going to be bad for the market. There was one worry. And now it feels like it's a bit ambiguous, like you can't really put your finger on it. There's more of a wall of worries. So do you feel that way as well?
Yeah, and I mean, I think you kind of touched on it. It's like, that's the typical, everybody's got different worries. They condense into some kind of like one big, like, everybody that's bullish, and you have all these finance professionals be like, well, there's this, and this. And yeah, I mean, I think there's a lot of that, to just breeze through them. There's obviously like the jobs market staying strong, corporate profits high, stock bonuses, along that, in a place where people are getting a lot and they could liquidate them and continue to put cash in the economy. There's kind of like, it's kind of funny that I'm saying this, but then there's also the reverse worry of consumer credit. And that's something that we've talked about a number of times, of just, I would say that's kind of on the other end of the spectrum. You have basically these higher class, tech jobs, higher paying corporate profits propping up the market. And on the other end, you have people that are just like ramping up personal debt, which, I do think it's hard to have both of those problems, by the way. If bonuses go back up, salaries, obviously part of some of that consumer credit is going to be, tech jobs and hiring around that. So I don't necessarily think you have both these problems, but they both exist in different scenarios, which is just, consumer credit. Everybody says that that's tightening, obviously from some of the banking collapses, but obviously also nothing makes consumer credit tightening than ramping up the total debt, where people start to be more concerned about how much, structurally the system can hold and individuals can hold before they start, kind of being unable to pay and kind of the snowball effect of those things. And obviously, when you have that in the stock market, that's a different thing too, where not as many people, everyday people, have money to put in. Maybe they're even pulling their money out of the stock market. That creates a shorting opportunity. Prior to what we're talking about, a lot of institutions still being short. A credit crisis, or the beginnings of one, could create an opportunity for them to kind of make their shorts win with more aggressive shorting of the market. Then we actually have an interesting thing, which I've read a lot of different articles about this, and then this is related to inflation as well, which is just like price gouging. That, essentially there were these upward pricing pressures in supply chain and a lot more cash flooding into the market, creating a lot more demand and way over the supply. But yeah, I've seen increasing amounts of accusations that companies are just continuing to raise prices above and beyond where inflation is going. And it's something that is just like, there's a lot of smoke to it. And, I haven't necessarily dug into the data that much myself. But I've read enough articles from different sources that, I don't think they would, I don't think that they come from nowhere. And it certainly is something to watch out for in terms of, what could be persistent inflation. And one of the things that you always have to look at when you're analyzing the stock market, and one of the things that's kind of important to me when I look at even what should be public companies and what shouldn't. As a public company, you essentially you need to keep showing profits, even if there's no more for your business to grow, and you have a mature business. And I think that that's kind of if you brought up craft, those kinds of things, you might be totally saturated. How many new products are you going to come up with as craft? I mean, I'm sure there's some, but as a percentage of your total sales, it's not going to be substantial. And you can't necessarily are you going to just spend a bunch of money doing R&D on weird ketchups and actually probably end up spending more money than you'd make?
Remember the green and purple ketchup?
Yeah. No, and I see all these specialty ketchups coming into their zone, but it's it's not them. They could copy it, I guess. But when you look at something, there's lots of different products that it kind of makes more sense for to just raise the price if you can get away with it. And I think that we're definitely seeing that continue to happen, and it probably will. As long as people keep on, that's kind of the demand side that we like to circle back, that Powell's worried about. That, even if, the actual, even if some of the supply issues are solved for, especially because just the economy is moving faster, and that was I'd say a big problem with how inflation started. So all things equal, even if the supply side is figured out and that's healthier, we might just have this demand stay really high and maybe even ramp up again to a point where it might be challenging to curb it. And you might even have opportunistic companies, capitalizing on the fact that they know they can keep raising prices. And I'm going to double back to, one of the things I was talking about public companies and, how it can be challenging sometimes is you look at, say, insurance companies. And I don't necessarily even blame them for this, but it's just one of those things that, especially health insurance, is challenging for a public company. And you look at that and you say how many new health insurance clients can people get? And they might be able to compete on price or what have you, but let's say for the argument that it's hard to really acquire enough customers to really move the needle for a massive health insurance company, right? How else do you make more profits? You deny claims. You make it harder, for people, you remove people with pre-existing conditions. So, I think there's something of, something that we've created in this kind of capitalist machine where it's just there's little things where you have everyday products where you're just okay, if they want to raise their prices, it's for everyone. You can determine if the ketchup is no longer worth it to you. And it's whatever, even if they're being a little predatory about inflation and knowing they can get away with these price increases and maybe people just getting used to them, that is what it is. If they go too far, you might try something else. Or, instead of going with substitute ketchup that's also raising in price, you might just stop using ketchup. You might say, I don't need it. And that's all right as consumers. But yeah, I think some other businesses where it's just like where you basically have to, try to screw over your own customers to make more profits. That's where it's just like, man, I wish we could figure out some better incentives for those companies than just this demand to constantly raise profits.
Yeah, well, that brings it to my mind, like you're talking about all of the product side, but are companies like financially engineering their profits, like with stock buybacks or any kind of tax incentives or stuff like that as well?
Yeah, they're always doing that. Like, and so like in not only in the in the what was it? I don't know if it was not it was like the one with the PPP, whatever the pandemic saving bill, whatever that one was called. Um, there were not only obviously were as part of the last administration, there were some corporate tax cuts, but there was also like a lot of subsidy, and PPP loans where like businesses that didn't even really need them got them. Um, and then there was also just like tax breaks for people that like had real estate that like wasn't being rented out, or there was a lot of stuff in there that really drove these corporate profits. So yeah, I mean that is, I'd say, what made it so extreme for this inflation cycle. But yeah, like the stock buybacks are a huge thing. And they're always engineering, like there is a competition for dollars in the stock market. And, some companies are doing it with dividends, some are doing it with these buybacks. There's a lot of different levers that they could pull in addition to just like profit maximization and growth to the extent that they can show that. But yeah, they're very, very good at it. And there's like obviously CFOs that like know this back to front, and some that will even like go around to companies or advise. Or, like we talked about it in reference to Buffett before, that, one of the reasons he does so well is when he buys a company, he's helping to manage it and he's using his connections. And that's a huge degree of what Wall Street does. Like when I was even at like a smaller, like a $300 million hedge fund, when I was about, was 19 years old. I was talking to like CFOs and investor relations people that I'm sure like passed on my ideas. Like, because I would dig into the business and I was by no means an expert, but there was definitely a few that they were like, oh yeah, that's not a bad idea. We'll run it up the flagpole. Like, and who knows if they were just being nice or whatever. But there was one company that I did definitely see use my idea. But that is to say I was 19 years old. Like, anytime you have these large stakeholders in your company, especially like, it goes all the way up to activist hedge funds that are like very actively trying to move the strategy. But I think Wall Street plays a big role in that too. When a fund takes a big stake in a company, like a lot of the times it comes with it plans for profit maximization. And when in the competition for dollars, it's a very interesting part of it where it's just like, the higher your stock price, the higher you can issue shares at, and the more attractive it is to be employed by you, because your stock options, essentially you're retaining people for cheaper as your stock goes up and you're making a more attractive compensation plan. And yeah, that's like a very, very big incentive. So you have Wall Street on one side basically saying like, oh, I have these ideas that are going to like increase your profitability, but like I'm deciding whether to buy your stock. Are you interested? Are you willing to do these? I want to buy a massive number of shares. But then the other side is like, there's a carrot and there's a stick. They could short you, or a bunch of people could short you, or your other investors could pull out because they call them up and say, oh, these guys won't play ball. They don't really want to make money. We should go to their competitor or whatever. So yeah, a lot of that is like, not only the ideas are driven by Wall Street and institutional money, but yeah, there's the other side to it where there's, you have oftentimes very little options whether you can take the advice or not. Now, that is to say, you get to a certain size, like, I'm sure there were a lot of people in Mark Zuckerberg's year telling him what a bad idea the metaverse was, and they didn't want him to spend money like that, and changing the name was stupid. They already had a brand. Like, I'm sure there was a lot of people, but you get to be that size. You're Mark Zuckerberg. You own that much of the company. You don't have to listen to hedge funds at that point. Like, obviously, he felt it on his bottom line, not listening to them. But it wasn't the kiss of death. It's coming back. He's changed his strategy. Like, we've obviously talked about, Meta and how we think it's a good value now. And I just actually shared something on the Twitter from the Motley Fool saying of the FANG stocks, that they agree with us that it's the top of the 7 in terms of value. And it does. It's like it got hammered a little too hard because of that stupid move, and we think that created an opportunity. But yeah, like you have to be very, very successful and large for you to be able to tell Wall Street to screw off. Like, it's not something. If you're a small cap stock and some investors are coming and approaching you and telling you that these things make sense for your strategy, a lot of times they'll buy it and then say that. And say like, oh, we're in this, but if we're going to hold, we need you to like pursue these strategies. Very hard to say no to that.
I've been seeing I guess they're trying to change FANG now since Facebook is Meta and Google's Alphabet. And so I've seen they've been calling, I think it's Magnificent Seven, and they want NVIDIA and something else in there as well, Microsoft. So they're trying to change the little slogan now. It's funny. But I have one more question before we move on from this topic. You mentioned dividends and buybacks. Are either of them superior in your opinion, or are they just the same, different names?
I mean, personally, I prefer buybacks. Like, dividends is just money going out the door, and it might keep people happy, but like someone could grab a dividend and then go launch to the other stock if they want and sell your stock. Like, buybacks, you're aligning interests, where you're saying, I'm buying back the stock because I expect the stock to go up. There's stocks that make their bread and butter on dividends, obviously. And like, you have to establish yourself as like a dividend, like, the people that own Coca-Cola, they're in it. They're not going anywhere. So like, there's not people that are like buying and selling on the ex-dividend date. I'm sure there's some people, but it's not a ton. But like, yeah, I just think that like, I mean, I'm much more of a, I would say, value and growth investor. I care about both of those things. I talk about it a lot. Some people say you have to be one or the other. I disagree. I mean, probably the way I describe myself is growth, like with value, that I'm not ignoring it, but I'm looking for growth. But I cooled off of that for a while, and I just started sharing a model portfolio. And one of the reasons I didn't share it for the first, like, I would say 10 months of our newsletter, was because I didn't necessarily expect to hold stocks for that long. I was just like, I can't guarantee I'm going to hold this growth portfolio for more than a few weeks. But I switched because I'm starting to feel, good about my growth things again. And obviously the model portfolio did very well last week. Hopefully that continues.
Yeah, and another stock that's been doing really well, I think off student loans coming back, is SoFi. And how does that look in Prospero?
It's funny, like I've looked at it a number of times and I've seen like, in the last, year or so, because it's always a hot retail stock, and the downside breakout was higher than the upside breakout, which is pretty much a no-go for me, because that means that basically there's greater demand for puts below the trading price in the long-term options markets than calls above the trading price in the long-term options markets. And no matter how good a stock is doing in the short term, I don't want to invest in a stock that institutions are betting long-term against. But that's flipped. And now it's up to almost a 70 upside breakout. Net option sentiment and net social sentiment is looking good. Like, it looks like a great time to be in SoFi. Obviously, those student loan payments are due to start again, and that's going to really help their cash flows. So yeah, I think that, obviously it was hammered because of the pause and nobody really expected that. But yeah, I mean, there is some risk. I wouldn't recommend a great portfolio concentration over this. There is risk. Because like, who knows if there's another pause? Like, it might be something that this administration doesn't want to touch that before the election, but if they get reelected, they're going to pause it again. Or even just threaten to pause it in the cycle to win over voters, and that could hit the stock price.
So there's risk. Run on it again, right?
What?
They could try to run on it again, like pause it, keeping them pause or whatever.
Yeah. So there's that risk. but I would say that like obviously this is a if the pauses end and the payments just start coming in again, that it's a great stock to own. And I would say risk reward right now is looking good on it. The Prospero signals would agree to have it as, I would say, no more than 5% of your portfolio. And I would favor like just owning it, selling covered calls on it, or I would say leaps would be maybe if you want to take risk. Actually, as I'm talking about it, I'm not sure covered calls are the right strategy, because it's more of like a news event. So yeah, I would say own the stock, or even sell puts that are 20% below and just collect that. And if it hits, it's at a good price for you to get in, or maybe even more than that. But yeah, I would say maybe like if you want to take on some risk, just having leaps is a good way to measure that. And like, yeah, I wouldn't make it a large part of your portfolio, but yeah, it's looking good, and there's a business reason for it. And I would say like what even lowers that risk a little for me is the fact that like if the economy is turning around, if the stock market is turning around, I think a big reason those were paused is like economy going down, like stock market in the tubes. Like I don't think the administration wanted to, obviously college loans were part of their platform, and like, yeah, it would be a real bad look for them in front of voters to have the economy doing bad and them not follow through on that promise. And they didn't even get it. They didn't even fulfill the promise as much as they said they would with like the actual reduction. I mean, they tried, weird Supreme Court case, but I don't want to even get into that. But yeah, I would say that like overall, Prospero, like SoFi, I wouldn't put it in our top 10, 15 stocks, but if you like it, I would say Prospero agrees that it's a good buy in terms of risk reward overall.
It's interesting how the whole regional bank crisis like is just slowly fading away. It feels like it never got resolved. I feel like.
Yeah, I mean, I think part of what it is, to be honest, is like we kind of saw the most toxic parts of it all get bailed out, right? And I think that that's a big like difference in the sense that like obviously in the '08, we saw Bear Stearns go down, and we saw Lehman go down, even though they could have been saved. That was a weird situation, definitely worth looking more into if you're curious. But none of the banks went under, right? They all just like, they all were able to, find other homes. And I think that that's a big, especially Credit Suisse. I think that one was the one that could have really caused some chaos. Because I don't think the European banks, like that's a little bit, they don't necessarily even have as much capital, and it's complicated because it's like different international governments. Like it's easy for us to just like, obviously for all of ours to say like, okay, we want to support the system. But if those banks are kind of like teetering over other European banks that are obviously more intertwined with them, that's a whole different. So I think that was a really important save. And obviously they worked really hard to get that deal done. But I think that like, yeah, I think that it was the backstops that ended up basically really helping everyone. That I think beyond that also put confidence in the market that like it wasn't going to fail, it wasn't going to tailspin because we were on top of basically, or the U.S. government was on top of saving these banks.
Yeah. So now going from one market where there's nice backstops to make everybody feel good to crypto where there's nothing, just thin air, and you have Gary Gensler coming out and basically just going after it last week. So what do you think is going to happen with crypto?
I think all of the following things about crypto. Like when I was feeling more confident about it, and long term, I still think it's like 5% of your portfolio. I've talked about this a great I think overall blockchain is here to stay. Where I struggle is like I'm not sure if it's Bitcoin. Like everybody that I know that are engineers that like look at this stuff are just like, oh, like they haven't really solved the best blockchain implementation. There's better ones, there's newer ones. Like even I've heard that about Ethereum from one of my smartest engineer friends. Although they do like Ethereum better. So like to me, that's one thing. Like I'm sure blockchain technology is around to stay. I actually like Block, which is diversified blockchain, BLOK. If people are looking for exposure, looking to get in a discount, I think that that's a good one. I'm not sure I would recommend now. But basically, like when I became more confident in it, I saw a lot of institutional money start to go into it. And like I do believe it would have been much bigger if that FTX thing didn't torpedo all of it. And obviously there's Terra and all of it, but like who knows? I think Terra would still be around today if FTX didn't happen. Or actually maybe I'm not sure of the order of those things. It might have been, I think Terra might have gone down before it. It might have been the reverse. So maybe it's the opposite. I'd have to look at the timeline of that. But yeah, I think that like FTX, and there was so much big money wrapped up into it. And I think that like the people that weren't involved in crypto, the powers that be, and like I said, like until the big institutional money, and I know a lot of like big hedge fund people that did get involved in it. Until that got in, I was like, no, I'm not very bullish on it. But that definitely happened. But on the other end, there's too much, like, it's important to look at like the markets as, I would say, primarily competing with each other for dollars. And obviously money in crypto is less money in stocks, and traditionally stocks and bonds have that kind of competition, but they're all kind of competing with each other for dollars. So the people that don't want to be in crypto and want their like more traditional asset bases, I think we're looking for blood in the water. And like, I think it's easy to, obviously a lot of this stuff is lobbying, and I think they would have very much liked, a lot of people would have very much liked Gensler to do this kind of thing, and obviously limit altcoins is what he did, or basically say everything other than blockchain as a security token, or everything other than Bitcoin as a security token, which is just means they're a lot of them are in violation of securities laws. They might have to re-register. Like there's a whole nightmare that might cause like a lot of them to collapse, and we'll see what that happens in the coming days, maybe in weeks, months. But yeah, like I think that it's nothing that a lot of people in the government didn't want to do, and probably like a lot of traditional finance people, which Gensler is one of them, would have loved to do this or loved the opportunity, and FTX, kind of gave them that opportunity, and gave them that opportunity to say this is not safe. So, if we look back at the cryptos, and by the way, like I consider it like, yeah, maybe I buy block if I bought anything, but I consider it pretty radioactive right now. Like I traditionally say, make it 5% of your portfolio. Like now I'm saying make it if you really want it to be that. I don't own any anymore. Not even block. But yeah, I think that basically where I'm at with that is, yeah, just like wait and see. You might want to, if you're hardcore into it, you might want to just like look to see what a good entry point is. But the way I look at it more than anything is there's such great opportunities in tech. And I think that's kind of how some of these, cryptocurrencies look like. Wow, like you can't see a growth multiple like that. Like, and I do think there's some tech names that you could see, like ENVX, I think could like, I think it could 4x, 5x in the next year or two. And that's why I keep talking about it. But yeah, so like if you can get that in a tech name, like why would you take on this? Like nobody's going to stop ENVX from trading, in any place. So yeah, so I think that that's like a big part of it, where it's just like, you got to know, like you got to manage the risk. And I just think for now, it's just like too big of a risk in cryptocurrency to not look for like attractive growth opportunities in the stock market as it's turning around. Because this might not even be like the end. Like Coinbase, like Binance is facing trouble. Like Coinbase is coming for a lot of its business. Like, I mean, and if Coinbase like falls, right? Like there's not really any big crypto exchanges left. And then I feel like maybe a lot of these more casual investors in Bitcoin, it might be a while until they come back, which is why I called it radioactive. Like until we see, like I at least need to see that Coinbase is going to get through this maybe 3-6 months from now before I'd even consider putting another dollar into crypto or blockchain.
And I believe I read in your newsletter, you think that with all the uncertainty in crypto, it could actually benefit stocks if people pull money out. They have to put it somewhere, so they might go into stocks and boost liquidity.
Absolutely. Absolutely. And I think that's part of my bull case right now. That's making me feel more strong bullish. We named a lot of, economic risks. But yeah, there's got to be a lot of people pulling out of those things that are growth investors. I mean, definitionally, the people that were investing in cryptocurrencies were looking for massive growth. And like, it's hard, like it's an easy transfer right now to be like, oh, like even look at Tesla. Like I don't know, like looking at Bitcoin versus Tesla right now, I don't know how I could like have any dollars in Bitcoin versus like Tesla versus like what it's doing and the announcement that they made last week about the EV charging stations. Ford and GM are going to be on their platform. Like, yeah, it's I know people, and I will say this, and I do support it. Obviously, like this is a big philosophical thing for Prospero. I do think everything that blockchain and crypto stands for in terms of like, maybe not all of them, but decentralization, I think is a great idea. And I do think that, in theory, there's a lot that needs to happen in practice to make that good. But it's something I very much support. And I do think decentralization and shared ownership of financial institutions and financial data is something that has huge potential to create better institutions. So I do want to say that. And if your money is in it for those reasons, all the power to you. But, I like to think of it myself as, Prospero is kind of my activist investment, you might say. I'd like to keep my actual money in what I think is going to return the highest. And I think, honestly, like, as I said, all the power to you. But I think as an investor, it is important to separate like activism and investing, because I see a lot of people in AMC and GameStop just like losing their shirts, and they don't have a good answer whether they're, revolutionaries or investors. And a lot of them like won't cop to being a revolutionary, but then won't actually have an investment thesis for AMC. So like, it's like in denial about being, revolutionaries or activists or whatever. And I say that as someone that got involved in AMC because I did like the message and the return potential. I liked both. I liked the activism and the return potential. I think it's really important for people to focus on that. And I support activism. I support building better institutions. But if you don't have tons of extra money sitting around in the bank where you can, where you've got millions or even hundreds of thousands of dollars, if you don't have that sitting in your bank account, I would say, just for me, I don't think you could really afford to be an activist. That's just my opinion. But as I said, all the power to you if you do want to do it that way.
It's funny you mentioned Tesla when we were talking about crypto. They were actually one of the companies that bought Bitcoin and then they sold it higher actually. So they made out on it. But and Elon still is like interested in Dogecoin. So I'd love to hear somebody ask him what his take on it is nowadays. But we covered
a little
all
Berkshire Hathaway. Yeah, a little Berkshire Hathaway play for Tesla.
yeah. It boosted their EPS one quarter.
Yeah.
We covered all of our topics. Anything else you want to touch on real quick before we finish?
No, do we have any questions? We had our biggest audience today. Thank you.
Yeah.
But no, I think like, yeah, I would keep my eye on one of the things that I like recommend for these things. Obviously, we mentioned Confluent, we mentioned Oracle. I like to do like limit buys on these kinds of things where it's just like, hey, put it like 3% above like where it's trading now. If you're just like, I don't know if I want the downside risk, you put it 3% above, you're not going to buy the downside. Like, yeah, it might rip and go down. But if you really want to do it, you could trigger like another, you could trigger like a stop limit. But yeah, it's definitely something that, I would look at those. But yeah, the one other thing that I want to close with, and I said in the newsletter, make sure to have your stops on. I am, in my model portfolio about 2-to-1 bull versus bear right now, but that's me being very bullish. I'm normally in my prior newsletters more 1-to-1 as this market has gone. So 2-to-1 is a big bull turn for me, but still I would recommend extreme caution against losses, because as I said, these shorters, if there's a bad CPI reading, it could snowball quickly. So make sure to have your stops on. I recommend 20% below your positions going into these big news events. I typically do, I have 20% for options, maybe even a little lower, maybe even like 7.5% for stocks. Because I think they just like, options, you could stop out of it really quick. Even at 20%. Whereas stocks, I feel like if they start going down that much, like you don't need to wait for them to go to 20. You can get a pretty good idea at 5% that it's a bad turn. But yeah, that's my last piece of advice.
All right, awesome. We'll be back next week, Monday, 11 a.m.
All right, thanks.